The wealth gap in real estate isn't widening by accident. While you're watching, rental yields shrink in your local market. Institutional investors are quietly building positions in countries you've never considered. And here, guess what nobody is telling you. The window to build meaningful real estate wealth as an individual investor might be smaller than you think. Let me be direct. The real estate game has fundamentally changed. We're watching three forces converge simultaneously. Institutional capital is moving faster than ever. Off-market deals are disappearing before they hit public listings. And international diversification once reserved for ultra-high-net-worth families is becoming essential, not optional. Here's the reality. A decade ago, you could buy a property in your city, rent it out, and build wealth slowly but surely. Today, that same strategy is competing against private equity firms, family offices, and investors with global reach who are analyzing 20 markets while you're stuck refreshing Zillow. But here's what actually keeps me up at night. It's not just that the competition is fiercer, it's that the fundamental structure of wealth building through real estate is shifting beneath our feet. Look at the data. Since 2020, institutional ownership of single-family rental properties has accelerated dramatically. Meanwhile, the average investor is still thinking locally, still comparing cap rates in their own backyard, completely blind to how capital is repositioning globally. And here is the part that matters for you. The investors who recognize this shift right now, not next year, not when it's obvious, are the ones who will build generational wealth. The ones who wait. They'll spend the next decade wondering why their single market portfolio underperformed. Let me break down exactly what is happening. First, capital concentration. Wealth is UNJ just growing it as consolidating into fewer hands with better access. Institutional investors are buying properties in bulk, often paying 10 to 15% above market specifically to exclude individual investors. They're not competing with you. They're removing inventory before you even see it. Second, market privatization. The best investment opportunities are increasingly happening. By the time you see a listing online, it's already been passed on by 3 private networks. This isn't conspiracy, it's efficiency. And if you're not plugged into these networks, you're shopping in the clearance aisle. Third, geographic arbitrage. While everyone is debating whether Austin or Nashville is the next hot market, sophisticated investors are building positions across continents. They're not predicting markets, they're diversifying exposure, because here's the truth. No single market outperforms forever. Now, here's where this gets interesting, because I'm not here to sell you doom. I'm here to show you the window that still exists. Yes, the game has changed. But that change also created an opportunity most people can't see yet. Here's why. Barrier to entry has dropped 20 years ago. International real estate investment required millions, legal teams, and boots on the ground in foreign countries. Today, structured platforms, legal frameworks, and partnership models have democratized access. A 6-figure investor can now build the same geographic diversification that once required 8 figures. Information asymmetry is shrinking. You don't need insider access anymore. Market data, demographic trends, infrastructure, project hits, all accessible. If you know where to look, the difference isn't information. It's interpretation and execution. First mover advantage still exists. Most investors still think domestically. They're still comparing cap rates in the same 5 cities everyone's talking about, which means the investors who expand their lens geographically right now are entering markets before the crowd even recognizes them. So what do you actually do with this information? First, expand your market lens. Stop thinking about the market. Start thinking about markets plural, global, diversified. Ask yourself, where is infrastructure spending concentrated? Where are demographic trends favorable for the next decade, not the next quarter? Where can your capital have 3x the purchasing power? Second, build for decades. not quarters. Short-term investors are competing with algorithms and institutional speed. You can't win that race. But long-term, strategically positioned real estate, that's where individual investors still have an edge. Because institutions optimize for quarterly returns. You can optimize for generational wealth. Third, access beats prediction. Stop trying to predict the next hot market. Start building access to opportunities before they're public. That means relationships with developers, participation in private syndications, and partnerships that give you institutional quality deal flow. Fourth, structure beats speed. The investors who win aren't the ones who move fast. They're the ones who structure correctly. The right entity formation, tax optimization, and financing relationships create leverage that compounds across every future decision. Here's why timing matters more than you think. We're in a unique moment right now. International real estate investment platforms are mature enough to be accessible, but not yet saturated enough to be competitive. Legal frameworks exist, but most investors haven't adapted their thinking. Give it 5 years, maybe Lasan, this becomes standard practice. Every advisor will be recommending geographic diversification. Every platform will be crowded, and the early positioning advantage that exists right now, gone. This isn't about fear. It's about pattern recognition. Every major shift in wealth building has a window where early movers capture disproportionate upside. We're in that window right now. Here, exactly what you should be doing today. 1. Audit your current portfolio. If 100% of your real estate exposure is in one city or one country, you're not diversified or concentrated. That's not a judgment. It's a geometry. One regional recession, one policy shift, one industry collapse, and your entire portfolio correlates. 2. Study markets you've never considered. Spend the next 30 days learning about real estate markets in 3 countries you've never invested in. Not to invest tomorrow, to expand your framework. Most investors limit themselves, not because of capital, but because of imagination. 3. Build your network before you need it. Start conversations with developers, fund managers, and investors operating internationally. Not to pitch, not to sell, to learn. The best opportunities come through relationships, not platforms. 4. Position 4, optionality. Set up the right structures. Now, entity formation, banking relationships, legal frameworks, so when opportunity emerges, you're ready to move. The investors who miss opportunities aren't usually undercapitalized. They're underprepared. Look, I'm not here to tell you the sky's falling, but I am here to tell you the rules have changed. And the investors who adapt to new rules early always outperform the ones who cling to old strategies. 10 years from now, you'll look back at 2026 and recognize it as an inflection point. The question is, which side of that inflection will you be on? Will you be the investor who diversified globally when it was still uncommon? Who built relationships with international developers before it became competitive? Who positioned for multi-decade wealth while everyone else was chasing quarterly returns? Or will you be the one wondering why your single market portfolio underperformed while others built generational wealth? The window is open, but windows don't stay open forever. If you're serious about building real estate wealth that lasts, wealth that transcends borders, survives recessions, and compounds across generations, then you need to think differently than 95% of investors out there. At Choyon, we don't chase trends, we build legacy assets designed for impact, resilience, and generational prosperity. If that resonates with you, follow our channel, because we're going to show you exactly how the top 1% of real estate investors are positioning right now. This isn't about getting rich quick. It's about building wealth that outlives you. Let's get to work.